You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. This episode is sponsored by PrivateLenderLink.com, where investors and brokers find direct private lending companies throughout the United States. In addition to promoting lending programs, the site also has a unique directory which lists private mortgage investment opportunities. Mortgage investors can use PrivateLenderLink.com as a resource to discover mortgage funds as well as lending firms that offer mortgage and trust deed investment opportunities. Review multiple investment profiles, do some research, and contact each company directly. And for all you loan originators out there who are seeking additional investors for a fund or notes, PrivateLenderLink.com is a great place to advertise your investment offering at a very reasonable cost. So get on your browser and type in PrivateLenderLink.com/investments. There's no fee to search and registration is not required. All right, everyone. Welcome to another episode of Lender Lounge with Kevin Kim. Today, our special guest is Steve Trowern with Templeview Capital and also MCM Capital, correct? The two companies?
MCM Capital, Templeview Capital, a couple other companies we started along the way. But yes.
All right. Well, Steve, thank you very much for joining us today.
I appreciate you having me on, Kevin. And I even appreciate more the fact that you pronounced my last name correctly.
I did. Oh, yes.
I've been married for 22 years, and my wife does not pronounce my last name.
Oh, I'm so happy because I was
on the first try.
Well, a lot of folks were really excited about recording this episode because we don't get a lot of time to listen in from people like yourself, Steve, because we don't really, we're at the trade shows a lot. We don't see out there. We were just talking about this. And so I really would like you to introduce yourself and the company for our audience, and we'll go from there.
Sure. So you're really kind of talking to MCM Capital, which is MCM Capital is really the original genesis of what we do. My background, I'll give you a quick background on me. So my background, I spent most of the 1990s in investment banking. I did telecom investment banking, M&A, corporate finance for Lehman Brothers. I had no exposure whatsoever to the mortgage side of the business. So the credit crisis that followed was not my fault. But we're doing our
everyone here is Lehman, right? They associate.
Doing my part to help clean it up. And then I started a company in 1999, sort of after the .com crash, prior to the .com crash, there was a lot of really interesting things going on out in California, and I was in London at the time. And a couple of friends of mine wanted to start a business in Silicon Valley to create sort of like a Dell of consumer electronics for integrating devices and music and content. It was sort of Napster and Dell kind of combined. And the idea was really big, that it didn't quite get off the ground. We didn't raise enough money prior to the crash. But one of the ideas that came out of that concept or came out of that experience, which I take no credit for whatsoever, was a little white MP3 player with a wheel.
Oh yeah.
And my partner Tony Fidel, a friend of mine from growing up and partner in the business, eventually took that idea and worked with Steve Jobs, and that turned into the iPod.
Wow.
So he was really, we were kind of there at the beginning. Tony's gone on to great fame and success by creating Nest and selling Nest to Google, and then doing some really interesting things now. And I'm still working stiff. So we.
You're in real estate, so it's okay.
Yeah, but I kind of like the idea of a really kind of working in an entrepreneurial environment, right? Starting something from scratch and essentially making it up as you go. And so I looked around for opportunities to do that same method, but maybe with a little less technology or capital risk, I should say, capital raising risk. And so we settled on creating a residential mortgage lending operation, which I grew with a couple of partners from 2002 until 2011. So we made it through that crisis, but the 2008 crisis was pretty nerve-wracking, right? Particularly when you're personally guaranteeing warehouse lines and world's upside down and your warehouse banks have run out of money. It was a really...
What kind of lending were you guys doing back then?
So we were just doing really kind of A and Alt-A residential conventional lending. Correspondent lending, we grew it to about $1.5 billion, year company, which in the early 2000s was sizable. By today's standards, it's not very big, but it was a great experience. But more importantly, it got me into understanding how the mortgage credit markets really function. And so we started to see in early 2007 and certainly into the summer of 2007, we started to see some cracks in the credit markets. And by this time, I had become business partners with a couple of folks near where I live, just outside of Washington, D.C., who later became my partners in MCM. And we were looking at opportunities to buy performing but at-risk mortgages that historically would trade for 98 or 99 cents on the dollar, and we're suddenly trading at 70. Right? It looked like a pretty interesting trade that we do for a couple weeks or a month or two, and then go back to our regular day jobs. That was 2007. There was some friends and family money raised to kind of, to develop a proof of concept. That led to raising a series of funds as a sub-advisor to some big financial institutions. Pequot Capital we worked for, they gave us a $500 million allocation to go and buy, essentially performing but at-risk mortgages. And then over time, one of two things happened to the opportunity. Either the price of performing at-risk mortgages kind of crept back toward par, or the mortgage or the borrowers themselves kind of fell down and the loans became non-performing. And that was a much more common result, right? And so as you got into 2009 and 2010, the opportunity really shifted to a distressed environment. Right. So there was a lot more opportunities just to invest capital into non-performing loans. And so our focus really shifted. We reinvented the company, really took it from a kind of a well-run, well-oiled sort of aggregation, purchase, refinance, platform to a distressed investment advisor, to a distressed asset manager. And we spent the next, call it 8 years working for large institutions. Oak Hill Advisors we had the longest sort of assignment with Oak Hill, but we worked for Neuberger Berman along the way, JP Morgan's trading desk. So we had big institutional clients, and we became a fairly institutionally designed and developed platform. In 2017, we decided to, as my partner Mike McLeany likes to say, we decided to stop being, Mr. Spock and want to be Captain Kirk. And so we went out. We raised our own capital. We got a commitment from a Middle Eastern sovereign wealth credit investor, and we created a fund to continue to do what we were doing directly in the distress space, but without any, without a sponsor essentially behind us. And it was very free, right? We were able to do things for ourselves. More importantly, we were able to develop businesses outside of our core mission that we had sort of been prevented from doing before due to, different conflicts of how the compensation would work for us or for our sponsors. And so we really kind of, were able to recapture the entrepreneurial spirit that we had in the early days of 2007, where it was just made up, right? And so we created a real estate, full-service real estate brokerage business called Alta Realty that also has a joint venture with the nationwide title company. And that was really to kind of get our best real estate agents there for us to help sell properties, manage REO, provide valuations, like really kind of be our trusted boots on the ground, because we were a nationwide buyer of mortgages, and we didn't have local representation everywhere we were, and so we needed to get that in the form of having agents and brokers working for us. But that business continues to the day, right? It's a real estate business, and that's growing, and we're certainly always looking for interested agents to join our network. So if there's anybody out there in your listening universe who wants to hang their shingle with us, we'd be more than happy to take that call. But we also really responded to a need or a demand from the investors who were buying REO and houses from MCM. Over the years, MCM bought somewhere in the range of 33,000 loans, and worked out of those 33,000, somewhere in the order of 8,000 or 9,000 turned into houses, whether they were through deeds in lieu of foreclosure or short sales. And so a lot of those houses were liquidated and sold to first-time home buyers, to regular retail home buyers, but also to real estate investors. And a lot of the real estate investors who were buying houses from us started to ask us for seller financing, right? And we had historically just had a internal, informal, pass the hat among the partners lending business, where if we saw a deal we liked, we would just pool our money together and lend into it. We decided in 2016 and early 2017 to institutionalize that, so that we could build kind of best of breed origination platform to continue to meet the demand of the people who are buying houses from us, but also just the greater shift we'd seen really in the private lending world, where you had taken an old-fashioned disaggregated kind of country club lending or small lender network around the country, and we started to see some of our peers who were becoming institutional grade, raising institutional money, accessing the capital markets, and putting in place more, commoditized is not the right word, but more of a standardization of product types and distribution channels. And we were, why we kind of in hindsight wish we had kind of, started our process a couple of years earlier, but we hit the timing right. We were able to raise a series of rounds of equity capital into a fund that we manage, and that fund continues, and we've got some separately managed accounts as well as our limited partners in that business, and we've successfully issued a couple of securitizations, and we've got repo financing, and we've got some partnerships with some large institutions that allow us to really be a market leader now at Templeview Capital in terms of fix and flip financing, ground up construction financing, and then rental financing, commonly referred to as DSCR, debt service coverage ratio lending, which sometimes bleeds into a non-QM world of lenders, but it's been a real growth opportunity for us, and we're pretty proud of where we are.
Okay.
I'll pause there and take a breath. But that's
it's a great story, though. I mean, I didn't want to interrupt. It's a really great story there, because it's very unique. I mean, we don't get a lot of stories like that. Kind of what was interesting among everything you just said is there's an interesting balance that I rarely see. Folks that come from Wall Street that have that institutional capital markets background, but then also kind of having that entrepreneurial kind of see a need, fill a need kind of approach to the business, and blending those two together, right? Because we see folks who are extremely strong at one or the other, but then when the two try to meld together, sometimes there's conflicts. And I think you guys approached it very well, in the sense that when you said you wanted to become Captain Kirk, right? And you took that independence on, but let's take a step back, because I'm seeing a lot of kind of common threads that I kind of pull at a little bit. Let's talk about the entry into the private lending space, because that's what this podcast is all about, right? Private lending. And
sure.
You guys jumped in 2016. But it really sounds like you were jumping in before that, along the lines of what the market was like before 16, right? Like, kind of like you said, country club deals, more fragmented type of approach. And these are just deals that you guys were doing privately, right? For the properties that you guys owned.
Yeah.
And so at the time, was it fix and flip as well? Was it more of like a short sale type of acquisition financing? What was the typical transaction for you guys back then?
I mean, really, it was anything. It was somebody who wanted to maybe buy a property, wanted to use a nursing home they owned as extra collateral. So it was really kind of bespoke, portfolio type of lending. But what we really did, and let me back up a little bit. So I talked about that kind of 8,000 or 9,000 properties. Of those, a third, so call it 3,000 properties, needed rehabilitation work in order to make them suitable for conventional financing or to maximize the NPV of the asset when we sold it. And so we started to do our own rehab work, for stuff that we had taken in, through foreclosure or through some form of, taking property or title to the property. And because of that, we had to develop a network of contractors around the country who would do do work for us on time and on budget. We had to understand how that worked. We had to think about what it was to maximize value and where and at what point in time and how long the project would last. And so all of these things that we were doing are really the same process and development and decision-making processes that are now fix and flip borrowers we're going through as well and continue to go through, right? It's the same thing. So we really when we decided to kind of create our own lending platform, it was really the beginning of the institutionalization of the market. And so the market really hadn't gotten there yet. There was a couple, larger lenders who I think we've since sort of, caught up to or largely caught up to. But we really took the approach to say, well, what would we want, right? If we have all these houses and we got to finance them, how would we do it? What would we want? What would we want to get? And so everything we've done has been kind of designed around satisfying the demands of the borrower, right?
Because you were the borrower in a lot of contexts. You were the builder.
That's who we are, right? So we are real estate investors ourselves, and we get it, and we get what people are looking for, and we get the flexibility they want to see and the responsiveness they want to see. And so we've not only designed products and processes around with that in mind, but we've also hired a lot of people who are from different backgrounds, right? Not everybody we have here came from a mortgage background. The senior leaders, we've got people from Wall Street firms, we've got people from law firms, different walks of lives. We've got people who are, in the operational or support staff that came from different backgrounds who are just smart and hungry and can help us figure things out. Because even today, with how much standardization has kind of come into the marketplace by virtue of having access to capital markets, that's provided some standardization or at least standard guideposts for the industry to kind of start to follow. You're still having to solve problems every day and make things up as you go.
Right.
So we like to hire people who have just a fresh way of looking at it, right? We don't hire people and say, who want to be told sort of what to do from day one. It's great when they come and say, you guys should consider doing the following, 3 things in this order, in this fashion. And because of that, we've sort of kept this entrepreneurial startup feeling about us while we've been very successful at raising capital and having a nice balance sheet that we can
I want to ask about that though, because you're hinting toward a nice topic we always cover on the show is is the company itself, the composition of the company. So let's go back to when you guys jumped into. Actually, let's go back even further. So you and your partner, I'm guessing, is it Nick? I think.
Mike Nicolini.
Mike Nicolini. Yeah, you guys started the company together, but I mean, two guys. I'm guessing it was the bootstrap kind of approach, startup kind of approach. To today, how many employees now under both umbrellas?
We've got a total of about just under 100 employees across.
Under 100 employees.
Yeah.
That's funny because I never really hear any companies in our space, no matter how big they get, to kind of exceed that number. It's always kind of sub 100. Everyone seems to like to have that kind of smaller company approach. But let's talk about kind of that culture, if you will, of entrepreneurialism and startup vibes, as I like to call them, because we kind of have similar approaches here. Like, we're a see a need, fill a need type of approach. Like, you can be on, my team, you can be a corporate attorney, but you see a challenge on the operations side, you can, volunteer to help, suggest a little solution, and the kind of all hands on deck kind of approach is how we grew. And I'm hearing similar, things from you. How did you guys foster that type of business model as you guys grow, right? As things become more institutionalized, people come lateral in from Wall Street companies, like you said, and they're probably used to a more like hierarchical, type of pyramid, right? So like, how do you guys foster that type of business mentality internally?
Right. So part of it, I would say, part of it is by design. So part of it, we hire people who we know will bring kind of a new, fresh entrepreneurial look at whatever they're doing. And it could be for someone who's joining as an HR coordinator, or someone who is joining as a COO or joining the capital markets team, right? Anybody that we're hiring, that's the quality we're looking for. We meet every single person that is hired here meets all the partners. Like, it's a requirement. And because of that, we've been able to kind of literally have the people that fit into the culture that we want to create. The second part of it is probably not necessarily by design, but by necessity. So we're constantly having to solve like problems. Like, again, what's different about this? And I've been in residential, consumer residential mortgage lending, and I've been in now commercial or business purpose lending. And the residential side, you have Fannie and Freddie and FHA. You have the government sponsored entities who create this massive sort of framework, and and there's vendors and there's software providers and there's so much infrastructure. It's the largest part of the U.S. economy, and so there's an enormous amount of infrastructure already in place, and you just have to sort of find your way through that or adopt the best technology you can find, and you should be somewhat successful because the road is already paved for you. And in business purpose lending, for all of us, we're solving problems that come up every day that we didn't anticipate. And knock on wood, we haven't had to face a shock of other than for April or March, April, maybe May of 2020 when COVID, when the shutdowns first started occurring and COVID really hit the U.S. hard. We haven't had any major exogenous shocks to the system, right? And I'd be curious to see how we all hold up. I think the sector will hold up really well, but I wonder if all of our peers will hold up as well as I think we will. During COVID, we didn't stop lending. We didn't furlough anybody. We didn't lay anybody off. We continued to hire. We continued to meet the demands of our customers, and we were there for people. That's because we were successful having a culture that stayed together, of raising capital. I think we were successful raising capital at Templeview by virtue of our success and recognition of the work we've done at MCM Capital. Right. I think we just kind of showed up on the scene with a PowerPoint deck. We would not have been as successful, but because we had.
Well, you guys also had multiple sources of capital, right? It wasn't just, and we talk about this a lot on the shows, like capital sourcing and reliability of capital. It sounds like you guys had multiple avenues.
Yes,
right? You had balance sheet capabilities, you had capital markets capabilities. You had all of it, so you weren't it wasn't that much of a shock to the system because you can rely on your balance sheet.
Yeah, I think that's correct. And our balance sheet, again, everything that we sort of are or do is usually either out of either by design or necessity. And we have made strategic errors in the past in our history where we have single sourced our capital, which puts you in a position where you're not really. You don't have the kind of flexibility or strategic opportunities you normally have. And so we've learned from that, and we will never, ever have single source capital again.
I think a lot of us learned that, after COVID, a lot of the industry learned, you got to have some sort of alternative solution, So
we had fortunately or unfortunately, we had learned it, before COVID hit. So when COVID did hit, we weren't scrambling. We weren't, we were cautious, right? We weren't going to be risk, we weren't going to ignore risk around us. And so we did kind of rein in some products a little bit just to watch and see where the market went.
Of course.
But because we had picked good partners, and I'll make a point to say that our primary bankers at Goldman Sachs, they were great. Our bankers, the Congressional Bank of California, they were great. Our repo providers had we weren't faced with a lot of margin calls or pressure. We already had our bonds in place, and so we had stable capital on the financing side. Our equity was stable. Our partners and our limited partners in that were great partners because we've shown in our past that we were able to weather different storms.
Right.
And if things south and our portfolio became more heavily distressed, we're workout guys.
I hope you're enjoying this episode so far. Before we move on, I really want to tell you about a great sponsor that's joined us for the show.
Have something new for us?
Of course, but better. Magical self-healing loan pixie dust.
Pixie dust?
Magical pixie dust.
And it does?
You just sprinkle it on your loan, and it does absolutely everything from start to finish.
Everything?
Oh yeah, everything. If a new loan comes in, sprinkle pixie dust on it, and everything is funded.
How does it know what loan to approve or how to pay?
Did you not hear about AI?
What about communications? Texting?
Oh, it knows.
What about borrower docs?
Or dealing with credit checks or appraisals, titles, fees?
It deals with it all.
So you mean we won't have to work anymore?
Never again.
And if something goes wrong, who handles client care?
Nothing will ever go wrong, obviously.
Sounds too good to be true.
That's not even the best part. Biodegradable, cheap, runs 24/7. And you won't regret it.
Heck, let's all go to the beach.
There's no such thing as LOS Magical Pixie Dust. But we have the next best thing. Presto, Next Gen LOS by Liquid Logics. We are simplifying the industry, saving you time and money in your end-to-end loan process, and bringing all the pieces of private lending to one system. Now, we can't promise you won't have to be involved along the way, but we can promise you won't regret having Liquid Logics on your side.
The workout capability, that's still there, right? You guys are still actively investing in distressed. I mean, it's not as available as it used to be, but I mean, still actively investing, right?
We made our MPL book at MCM is still continuing. We still run it. We still manage a multi-$100-million portfolio of MPL. The business purpose lending, the private lending has delinquencies. Like you get projects that fail. Like there is absolutely a need to do workouts and loss mitigation, and we do all that in-house.
There you go.
Some of the restrictions during the pandemic in terms of foreclosure moratoriums and eviction moratoriums took away some of the tools like the lien holder would normally have,
right,
or at least delayed them. And so the process has been a little bit more complex over the last year and a half.
Back to your problem-solving kind of mentality, though, right? I mean,
yeah. So then you have a problem, and you got to get everybody together and try to solve it. And sometimes it's as simple as, not as simple, but it's something that it's marketing related. Sometimes it's product, it's understanding where the world is, it's understanding where the world's going. So, back to kind of your question from a few minutes ago about, how we kind of maintain this culture. Part of it's by design, right? We want to be prepared and we want to be ready. We have our battle scars. We've been through things before, and so we know what to do when things don't turn out the way that you want them to. But part of it's just by necessity, right? Borrowers experience problems. Like right now, I would say that the biggest challenge faced by most of our customers is they can't find inventory, right? It's the same problem around the entire country. That's partly part of the reason they exist, because the housing sector in the U.S. is the housing stock is old. New home building is not keeping pace with demand. You've got millennial shifts, demographic shifts that are driving home ownership. You've also got demographic shifts that are driving Airbnb and short-term rentals, right? Where people don't want to stay in hotels anymore. They want to have the feeling of home away from home. And so we, as by way of example, we recently launched a DSCR product that is targeted toward Airbnb or VRBO. This is euphemisms for short-term lending or short-term rentals, but we're using, we rolled that out as a way to kind of help our borrowers build wealth through investing in short-term rental housing. Right? That's an enormous part of the market that's not being addressed by anybody else. But to understand how to do that and understand how to normalize the rental income rates, by markets, and understand where risks might lie out, against, longer-term leases and longer-term lease collateral, you've got to have different people involved in that decision making, right? You got to hear different points of view as to from operators, from credit folks, from capital markets. You've got a lot of constituents really to bring into that conversation. And
so when you're looking for these, whether it be, new associates or executives and you're trying to hire, like, what are you, when they meet the partners, right? What characteristics are you asking about or looking for? What specifically are you doing to evaluate this kind of problem solver mentality or this kind of entrepreneurial mentality to maintain this, kind of, because you said by design and necessity, right? But when the necessity comes in, you need to have that right type of person in that seat. So it's kind of a staffing issue almost of how you recruit people like this, and it's a challenge. It's hard to recruit in general these days, but especially when you're looking for that type of person, what are you doing to filter through the candidates and get those type of people?
So are you preparing your resume, Kevin? I don't know. We'd love to have
no, but I have a partner here, but I'd like to hear more about it. We have the same desire to recruit those types of attorneys and staff members, but it is challenging. Right. And we all want those types of people, I feel like. So
it's probably the most challenging component of any business. This is not unique to private lending. It's unique.
No, absolutely not.
Everywhere is facing, every part of the economy is facing the same situation. So when we're lucky enough to get people who want, who are looking for a job or who are available to us, you're looking really for people who have shown a pattern of being self-starters, whether that's in sales, certainly in sales, right? Now, when we hire account executives or business development managers, we kind of use those terms, euphemistically across the sales staff. But you want to see people who are not afraid to invest themselves, old school origination, finding relationships, finding borrowers, meeting with brokers, meeting with correspondents. We have an aggregation channel. Correspondence.
So almost like trying to look at the resume and look for examples of hunger.
Yeah,
that level of
hunger and confidence. Because to be a largely commissioned, salesperson requires some courage and requires some confidence in order to go out there and try to make it in a world where you're relying mostly on what you're producing. With the support staff or our kind of senior management, again, you're looking for people who have brought change or sustained change or just show a propensity to bring change to whatever they're doing. And sometimes it's people coming from another, maybe from their first job out of college, right? But you can see somebody that how they performed in school, where they went to school, not necessarily the caliber of the school, but how they approached their university, what classes they took, why they went there, what went into their decision making. That's really what we're looking for. People who show a propensity to have that, to when they're put into a situation, a collaborative situation with other people who come from maybe totally different backgrounds, that they can hold their own and they can feel confident in their positions.
But they can also be the one that starts actually demonstrably show that they've taken initiative to make a change happen.
Yes,
right.
And the way if you look across at our sort of 7 or 8 senior managers, most of them have been here since if not the beginning, then very close to the beginning. And all of them have succeeded because they just found things to champion. They found things that needed to be fixed and they went and fixed them. And
like that.
they didn't wait to be told. Nobody told them. Nobody said, this is a mandate and you got to go do it. And they just found ways to go and bring and come, call a meeting and say, here are the 5 things that I'm recommending or that I've already started to put in place, and this is why.
Right.
That type of person thrives here. The person who's waiting for command and control, probably, it's just not our management style. Have that.
I think those people thrive in this industry too. There's so many new, like you said, there's every day something comes up in this space, especially. There's always new challenges, new kinds of borrowers, new kinds of deals, new kinds of capital solutions, and it becomes a never-ending kind of firefighting type of business. And on the legal side and on the operations side, I've heard kind of consistent themes of that, right? And so that's awesome that not only are you guys hiring like that, but all the partners are evaluating the candidates, which is hugely important. I feel like maintaining that level of, I guess, like higher, almost organizational flatness, if you will, and that and encouraging that. That's cool. I mean, it's very hard as a company grows to the size of 100 employees. Like, partners don't have the time, to go sit down with, a new associate or a new, out of college, new graduate almost, right? And those types of hires. So,
yeah, we meet with everybody, but we also delegate. We know we have a great management team here who will train and integrate and promote them and get them, affiliate, get them acclimated to the culture.
Cool.
One of the things that I do tell all the young people who are coming in, some people are coming from traditional lending backgrounds or some other kind of professional background. That it didn't used to be the case when we were hiring for MCM, kind of in the early days of buying NPL, pools of mortgages. You didn't know when the next pool was going to come out. You didn't know if you'd win it. You didn't know if the government would step in and, freeze sales from the GSEs, which would impact the entire market. So it was very lumpy, very difficult to plan for, and it was essentially a trade. You bought a bunch of loans, and then you spent a couple of years working them out, and with the goal of getting them to zero. Like our whole purpose was to put ourselves out of business, if you think about it that way. Mm-hmm. What we really, really like about private lending and about MCM Capital is that we are manufacturing yield, right? We are getting credit for a perception of higher risk than Fannie and Freddie kind of paper for what is in reality not a significantly greater amount of risk. The collateral is very similar between conventional residential lending. The process is different. The credit is different. The project reviews are different. The evaluations are different. But fundamentally, the finished product, the collateral of a finished rehabilitation or a newly constructed home, is the same collateral, and you're getting better yields. And so, but one of the things that I tell people that we're bringing in now is that this is not a short-term trade. This is not where there's this sort of interim that all these non-bank lenders are filling. This is a permanent part of the U.S. housing sector, which is the biggest part of the United States economy, and it's not going away.
No.
There are the banks, for lots of reasons, historical reasons, regulatory reasons, really don't want to participate in the kind of bespoke, construction or rehab lending. Certainly not doing that on a one property basis. They might finance a home builder, but who has a development somewhere, but they're really not looking to do kind of what we're doing on a bespoke level. The rental finance loan, this is an enormous area of growth for this economy. It provides, as a real estate investor, I think it provides a great hedge to either, if you're a fix and flip, also manage rental properties, you're creating and adding value while you're flipping or you're rehabbing the house. And if the market is great for selling houses, then you can make your returns and go off and do it again. If the market isn't there or you don't like the prices you're going to get, people still need a place to live. And those same people who are being driven out of purchasing markets or purchasing homes, who maybe want to sit on the sidelines for a couple of years and wait to see how, when home prices begin to stabilize or the growth begins to slow, well, they're renters, right?
Mm-hmm.
But they need to live there and they're good credit. They're good. It's a good sector to have exposure to. And so you've got a hard asset that is, by definition, has some inflation protection built in, and you've got an asset that does well in an upward hot housing cycle or in a renter's cycle. And so it's really like, for us, we couldn't be more excited. And I'm personally much more satisfied in helping to build a manufacturing plant of yield and yielding assets than to buy slugs of loans that we then spend the next couple of years trying to get rid of.
Right. I mean, the nature of the NPL practice is you're just kind of digging yourself out of a hole constantly. And there's a kind of interesting practice to be in if it's in a vacuum, right? But like the private lending sector, I mean, you already brought it up, so let's kind of pull on the thread a little more, like the idea of the U.S. economy and the advent of the DSCR product for our clients has really taken this space and exploded it beyond what it used to be. I mean, the fact that, I would say now almost every major lender in our space is now doing DSCR in some way, shape, or form. Sure. But, balancing that with some of the concerns that not just Wall Street, but even Main Street investors have expressed on the inventory side of things. And, it's kind of, from my standpoint as an attorney, I'm no economist, I'm no financial whiz, but I can definitely kind of see like this. It seems like there's two almost conflicting issues going on here, right? You've got this super, super hot demand for more and more DSCR product, but also for acquisition in general. But then you have this massive, challenge. When it comes to investors who want to buy more properties, and also just homeowners who want to buy properties, and then balancing that against Wall Street interests that are buying up rental homes themselves. And it kind of makes me wonder, like, are we headed toward a pattern in which our owners are we going to be a society of renters, right? And it makes me wonder, like, because we have to encourage. Are we as an industry promoting a society of renters instead of home ownership and wealth building, right? And it makes me wonder, because like when private lending first started out, like we were all about wealth building, helping folks buy homes, build new homes, buy new homes kind of approach. But then with this DSCR product and just the massive appetite, it makes me wonder, is this almost like counter to our interest on the fix and flip side, right? Or on the acquisition side? What are your thoughts on that?
So that's a lot to unwrap. But
yeah, it is. But I've been struggling with this for a lot, because someone told me that some Wall Street firm is like buying up whole cities. So I'm just like, how do we expect to compete when they're buying up whole cities? So.
Yeah, I think the yes, having large institutional players buying individual properties has clearly contributed to the demand. And as we talk about, the supply is not there. We have not kept pace with supply since like the mid 80s.
Ever.
Been slowing down. There was a period during I think Reagan's first term where for 2 years we were building more houses than we were. Part of that was hangover from the inflationary period of the late 70s and the OPEC shifts or OPEC oil impact, and we're going way back. But if you actually look at the historical home ownership after the creation of Fannie, right? Because that's kind of the beginning of when you had like a government mandate for people to buy houses. The GSEs were created to promote home ownership, not renters, right? That's why the GSEs don't do a lot of this stuff, because that's not their mandate. Their mandate is to help people buy houses and live there. And if you look at the historical home ownership, it was in the upper 60s. So somewhere between 66 and 69%, give or take, depending on the decade, of homeowners versus renters. That home ownership peaked at like 72% in 2008. So you could argue that there's probably some, you've got components of the population that want to be renters because they want the flexibility or they don't have the stability in their home lives. And then you've got people who don't have the right wherewithal to maintain home ownership. And so when you get into the 70s, maybe that is north of the natural inflection point of what home ownership should look like. Maybe it does, it should be.
Is that staying steady, 70% ish?
It has been bouncing between 67 and 69%.
Okay. Well,
I think I haven't seen the latest data, but it's right in that range. And what you're seeing is you've got affordability indexes that aren't getting completely blown up despite home ownership, home prices going up. You've got interest rates continue to stay low, and they probably will stay low for a period of time. A Delta variant or a Gamma variant or whatever comes out, after, it's probably not going to change that dynamic. So I think we're in for a period of several years of continued low interest rates. Most economists seem to think that this inflation we've seen is really a supply chain working itself out after COVID. So maybe we'll see whether there's permanent kind of inflation and whether that drives interest rates. But what's really driving the housing market is not like interest rates or underwriting guidelines, which was the case in 2007 and 2008. What's driving it now is macro shifts. People buying their first homes, people wanting to buy second homes so they can work during a pandemic from the mountains or the beach or wherever. So we're seeing this whole thing that is a wide scale shift of how people view home ownership. But at the same time, you're also getting people who view rentals as just the more flexible natural option, who don't want to be burdened by owning properties. And those people used to be homeowners, right? So I don't think you're promoting a nation of renters as much as you're accommodating demand for flexibility in how people rent. I think probably what you'll start to see more of is you'll start to see more kind of lease to own type businesses out there, which we've seen, where people can kind of get out of the weight of the mortgage debt, but not have to vacate the house, and then can become a renter with maybe an option to repurchase the house or to sell the house, down the road. And so really people are looking for optionality and flexibility. Same thing the borrower's looking for. They want optionality, they want flexibility, they want to be able to react quickly. They want to be able to find new ways to add value. That's why we're seeing a real increase in demand for ground up construction because, it's hard to find inventory. And it's harder to find inventory that you can add value to, right? So, and get a return on the other end. And so until that changes, I think this is the world we live in. Like, I think we are just beginning to scratch the surface of the rental finance products because I think there are 15 or 16 million SFR rental properties in this country. And maybe that goes, let's say that number goes because Wall Street's buying houses and there's more people who want to be renters. Maybe that goes to 18 million. Like 2 million houses is an enormous number, right? In a world, in a country or a market where we normally see 4 million houses trade in a normal year, 2 million, houses to shift would be a huge shift, a huge macro shift. So I just think we have to be ready for whatever comes of that. Right? Be ready to
see a need, fill a need, approach.
Address the needs that your borrowers want. Right? That's all we're doing. Finding ways to meet their demands that are not being met by traditional,
And you raise an interesting demographic point that our listeners should really pay attention to. It's not just necessarily, because you're saying home ownership is kind of staying steady within a certain margin, but there's that change in desire from the borrower side in wanting, and this could be a product of instant gratification. It could be a product of just more capabilities, but the idea of being flexible, right? Having more flexibility, more customization has become, I'm that of that generation as well. Like if you tell me I can have it both ways, and I'm likely in, right? The idea of having flexibility is ideal for someone like me and others in my position. But even, new market entries for homeownership, there seems to be a demand for that. And I just wonder, is there going to be anything left, like you said, though, right? And I think, if as long as ownership rates are staying in a macro level, I agree with you that everything is kind of a macro perspective right now when it comes to new homes. I just hope that we're not facing a situation the situation that we're in isn't permanent, right? And I did an interview recently. They said they're starting to see some adjustments to these hyperinflated values. We're joking about this recently. There was this home in Washington State that was posted as a little slice of hell, and it was just destroyed. The internals were destroyed. Like it was, I don't know what happened. There's probably a family of, bears are living inside of it, but it sold for probably around $800,000, right? And things like this are happening, right? And like homes here, throughout the country are being bought. We're being bought for hundreds of thousands over asking, and like in a matter of days. So like, I want to ask you guys, like, what are you guys seeing from that standpoint to see, do you concur with, like, the last interview we just did was about they're starting to see a little bit of adjustments there, and it's getting better. It's not as frothy as it once was even a month ago.
Yeah. So again, you have to either affect the demand or the supply. The demand is almost unchanged, because every investor right now who listens to this podcast or has been involved in the sector for the last couple of years would jump at an opportunity if they saw it. Right, they haven't gone away. There's still demand. The macro shifts and demographics we talked about haven't gone away. Wall Street has raised, billions of dollars in private equity to go and build strategies out for rental. So those demands aren't going away. The question is, like, where does the supply come from? So you'll see some supply come out of the relaxing or the ending of foreclosure moratoriums, right? Because a lot of those properties they're not occupied in many cases. It's not like it's old ladies being kicked out of their houses. These are just properties that were rental properties before something happened. So it'll create more supply, and you're seeing more credit available for the rehab and the construction of new houses. Mm-hmm. And those two things will contribute to supply. Neither one of them is sufficient by themselves or even together to offset the continued demand. And even if demand were to fall by 10%, you'd still have a rising home price environment, because the demand will still outstrip supply, period. Yeah. So until you address that, and home builders can't bring on properties at a fast enough clip, and they've created this infrastructure and strategy, and they own a lot of land, and it tends to be in kind of exurb or suburban markets. And what we're seeing is COVID was a little bit temporary, where people moved to their parents' house or whatever, or maybe went to their lake house. But really, the beneficiaries of, like, if you look at the 2020 census, the beneficiaries of all the growth have been the cities, and those cities have they need to have urban renewal, so they have to have rehabilitation of urban housing stock, and you got to have infill of, and I don't mean like the inner city, but I'm talking about kind of close-in suburbs, and and the cities need to have some of those vacant lots built on, right? So that's kind of what we're. So
that raises another question then, right? Because we're talking about residential SFR for a long time now, but like with talks of metro infill and rehabilitation and improvements there, right? Increasing inventory that way, right? I mean, all of our clients who do SFR 1 to 4 family are doing condos, but there's also the component of multifamily, right? Yeah. And so while we do see a significant uptick in multifamily in the private lending space, we don't see a lot of folks that are doing it on volume, right? One of the objections that I've heard is because of the agency powers that be, right? And there's a ton of agency capital that's handling all of multifamily, but with a lot of the renovation work, rehab work, or conversion work that's happening, like what is Templeview doing? What is MCM doing when it comes to multifamily in this current marketplace?
So we haven't, because again, one of the things that I talked about before was that we were pretty successful raising capital for Templeview, because we had made returns for our investors in NPL land and under MCM, and people knew us, and we weren't new kids in the block. one of the reasons I think people had some trust in us is that we stick to our knitting. Like we have only done 1 to 4 family properties since the
so very disciplined. You guys haven't deviated from
haven't
that
changed.
class.
Have not looked at. We don't do any mixed use. Haven't done it. We do finance like conversions because they end up as individual units, right? For condo conversions. So we will finance those. But having said that, there's probably the next opportunity for a lot of these guys, and we have put some thought into it. But it would be a lie to tell you that it's even half baked. It might be an eighth baked. But to look at like 5 to 8 units, because there's a lot of similarities between 5 and 8 unit properties that do fit under FHA and GSE, guidelines.
Right.
They're pretty similar to a 4 unit. The difference between a 4 unit and a 6 unit just isn't that great. Like there's a lot of 6 units on college campuses around the country, which are great markets to lend into. The dynamics and the risk characteristics are just not that different. It's when you get in, north of like 12 units that it's a totally different animal.
Yeah.
And you really need to have local knowledge, and it's hard to do that in any kind of scale because we're a national lender, right? For us to do that. So I could see us potentially someday doing something along like the near 1 to 4s, so call it the 5 to 8 units, but really there's so much opportunity and such a need to address just in the 1 to 4 markets that we could spend the next 20 years doing nothing but.
That's true. It's
very
true.
Service. Yeah.
So I want to ask you guys about, you mentioned this very early on about, spotting cracks. You said you went back in 2007, you started spotting cracks in the credit markets, right?
Yeah.
And with your investment banking background, you started seeing those cracks in the credit markets, and, COVID was a credit market liquidity type crisis for our industry. I would say short term. I think most people pivot and figure things out considering how much capital is available right now. But going forward, like, what are the fundamentals that you guys were watching back then that we should be paying attention to looking forward?
Well, so just talk about COVID for 1 second. Don't underestimate the impact that the Federal Reserve had on its messaging and on its bond, its bond purchasing programs. Right. I mean, they've been, Jay Powell has been very clear that they are not doing anything other than maybe thinking about tapering till 2023. And I think that has had an enormous impact on the credit markets because they learned their lesson. What happened in 2008? The Treasury kind of, did a TARP, and it was sort of a made up number, and the Fed cut rates a couple times, and then it
was absolutely made up number, the blank line. They just filled it in.
But it wasn't until after the world had completely fallen apart. It was not until Bear was gone and Lehman had filed bankruptcy that the Fed, really several months afterwards, before that happened. Lehman Brothers filed bankruptcy in September 2008, and that real big bond purchasing and Fed actions didn't start until October, November, right? And they've learned their lesson. The current Fed learned their lesson from that period.
It's good to hear the government learn their lesson for once.
I mean, to their credit, like it was, you got to come out with every gun blazing on your battleship, and then figure it out later, versus trying to target your, target their.
They definitely deployed those capabilities during COVID. You think that was the primary driver, what allowed basically our market to stabilize?
And I think it was, and I think that the fundamentals, like when you started to look at really where the pain was from the shutdown, was really more in the kind of the service world, consumers, and so it wasn't that widespread. It was really targeted. The pain was like on the baristas and the restaurants and Uber drivers. It was not so widespread and manufacturing and housing. So I think once people figure that out, on top of that with the Fed action, it was really largely over by June, right? The green shoots had started the green shoots of positive kind of, healing we started to see in May, maybe April, but really May of 2020. And by June, it was, essentially, I think everyone had realized that we were going to weather this, that it wasn't the end of the world. And then
well, I hope some of our listeners pay attention to this, because some of the people are still worried. I mean, I'm not going to. I speak to folks all the time about this, and they're still worried about things. So
yeah. Well, I don't think we see another. I don't think we see shutdowns. I think we will be living for the next several years. We will be living in an environment of masks and unmasks and booster shots and COVID misinformation and vaccine misinformation and all those things. And I think that the investor community, both institutional and retail or local, I think are able to see through that. So I don't think that's going to derail us. I think it will probably cause minor challenges for here and there. Sometimes for tenants who can't afford their rent, or for landlords who can't afford not to have their tenants pay the rent. There's going to be some kind of ad hoc challenges, but
not any massive, no massive crises like we saw in the reaction in March.
I don't think there's any political. I don't think there's any political will or capital anywhere in the country. Even in, go to Massachusetts. I don't know. Pick your bluest state. There's no political capital or will to have an actual shutdown. I think you'll see targeted things with masks required and probably mandated vaccinations or vaccine, proof of vaccines to get on a plane or to enter a stadium. But those things, they're just rules, and people will find a way to comply with the rules.
Right. We're not going to see any kind of crisis come from this. No. Well, I actually raises another. Always ask this question to our guests. Foreseeable future for the private lending space specifically, and since you guys are focused exclusively on 1 to 4 family, bullish, bearish for private lending?
Really bullish.
Fantastic.
Like really bullish. Because again, all those things we talked about. It's supply and demand. There's nothing. There's massive tailwinds behind the demand. There's nothing that's getting in the way of the demand, and the supply is slowly trying to catch up. It won't.
And no indications of any kind of crisis that are going to kind of get in our way.
Yeah, barring I don't know, maybe a massive terrorist attack or a whole new virus that no one's ever seen that requires another vaccine.
Act of God.
Barring act of God, then we can never predict those.
Right. Well, that was 2020, right? Straight up act of God. We had no way to see this.
No, and if we got through that relatively unscathed, then we're going to get through. But anything. So you've got real macroeconomic factors that are driving this, and so and what I think you'll probably see in the private lending sector, there are depends on who you count and how they're set up, but there's probably a dozen sizable lenders, like private lenders, probably more than that, if you kind of go into the smaller tiers. But like, let's say there's 12 who have access to capital markets and who have histories of raising capital and surviving through ups and downs. I think that those 12 will start to gather more market share of the overall market.
Mm-hmm.
I think the haves in this will start to weed out the have-nots.
Mm-hmm.
The small lenders, the pass-the-hat lenders, whose capital is maybe from a family or from some high net worth individual or a mezzanine fund or some credit fund. I think that the cost of capital argument will start to wear on those. I think you'll see the 12 of us. It's a ballpark. I'm using that as kind of the overall.
I'd say around like 20 to 30, depending on there's some folks that are more on the aggregation side, not on the lending side as well. So it's kind of an interesting proposition there. But, I mean, that's an interesting question though. Cost of capital, right? So you're saying you're predicting a continued competitiveness in pricing for interest rates, and rate compression is going to continue, you think?
I think you'll see some rate compression on certain products. I think the spreads have kind of stabilized on the DSCR for the most part, and I think that, but in order to, again, it's not just the cost of capital, so that you're the market leader in price, but having cost of capital and reliability of capital to maintain margins, so you can continue to grow. And so, if you want to use your number of 20, I think it's 12, but let's say it's 20. I think those 20 there are probably 700 or 800 like lenders or brokers. There's 7 like participants, market participants out there, and I think you will see a lot more of the market share go to the bigger, the 20. Whether they're aggregating or buying, or they're a broker source or a capital source for the smaller lenders. I don't think the smaller lenders go away. I think you'll just see more market share concentrated in the hands of the 20.
Well, that raises another interesting question. We've had other people on panels that I've been on and moderated, like predicting a kind of patterning towards conventional, right? Where you kind of have almost a pseudo GSC type arrangement, right? And you have your programs, if you will, like Fannie, Freddie, Ginnie, FHA, that kind of stuff, and those will be and then you'll have a massive market of originators. That was a prediction by a colleague of mine. They work for an investment bank, and that's what their prediction was for. Do you guys agree with that? Is that how you guys see this market headed, or are we looking to be a little bit more bespoke?
I think it'll still be on the fix and flip and ground up. It'll be a little bit more bespoke because, but you have seen standardization, and the reason that you've seen standardization is because, again, those 12 or 20, they're the ones who have access to capital markets. That's why I'm making that kind of the differentiator. The fixed income investors are the ones really setting the rules for what loans are being made, and so whether they're a rated security that's full of DSCR loans, or whether it's an unrated short-term revolver that's a fix and flip and ground up construction and bridge.
Yep.
The guidelines are going to start to kind of morph and look similar. So they'll have similar programs, and then it's just a question who has the most reliable access to that capital they can continue to share and maintain their margins, so they can grow and hire and continue to do to meet the needs of their borrowers.
So you're suggesting more of a standardization of underwriting.
Yes.
Okay.
Yeah.
Okay.
Yeah, I think, and that's happening. It's been underway.
It is. I mean, I've seen a pretty much standardization when it comes to anyone who's working with a capital markets provider, aggregator is pretty much doing the same product. But it raises a question, though. I have plenty of clients, and we've had guests on the show. They've built their brand around doing, more of the esoteric stuff that they can do because they're independent, or they're not tied to a capital markets provider. Their balance sheet, their true balance sheet, whether it be family office, whether it be high net worth investor or institutional.
It depends on where their capital came from and how much it cost them.
And that's a uniform challenge. I think everyone on the show that has a balance sheet has always talked about our objective was always to get the cost of capital down.
Right.
So if your cost of capital is 9%, you're just not. It's and you're scaling to $500 million to $1 billion. You can't. It's just hard. You can't sustain that. So.
And my other prediction for this sector would be that you've seen it already happen, but most of the independent guys in that 12 or 20 number have either been subsumed by their sponsor or by one of their main customers.
So there's consolidation.
You're going to see some more consolidation. I know of 3 that I don't know whether they've been in the public domain, so I won't mention them yet, but I know both happened recently or will be done shortly.
Yeah, I think I know what you're talking about. Yeah.
I'm sure you can.
Yeah, and there's probably 3 others that we're not even hearing about yet that I've heard the whispers about too. So I mean,
and there's one big one that's going to get done shortly. But we remain TWG Capital remains independent. We don't have a sponsor.
Yeah, I was going to ask that. Yes, there's no talks about that for you guys. You're going to stay that way.
There's never say never, right? I mean, it depends. Like it would make sense. Like one of the things about these businesses, not to get too far off track here, but our capital is essentially fund capital with that we have our own money in, and then third party money, with institutional credit, so bonds or repo, facilities, and it's essentially an operating business. Like it should at some point be an operating business with a permanent balance sheet. And so, at some point we will probably look to, find a partner that is a longer term partner, not somebody who's just willing to accommodate, something in order to get assets, but really kind of looks at this as a long-term
Well, will you demand operational integrity and independence? Is a good question to ask there, because that's an M&A that becomes the big,
Yeah, depends on the partner, depends on the deal, depends on the price. Right?
Makes sense.
Somebody said I was asked by a 8-year-old recently about a house. Like my house, he just kept asking me if it was for sale because he liked the color of like a wall or something. And I said to him, like, his name is Sebastian. Sebastian, like, everything's for sale, dude. Just
in the price.
Make me an offer I can't refuse.
Yeah, that's true. That's true. And that's happening, right? It happened before. It's happening now, and I wonder what it's gonna do for our space. It's interesting how we're starting to see entries, exits, consolidation, joining forces. It's going to happen. It's a foregone conclusion. But I like to hear you guys maintain that entrepreneurial spirit about it, and that's I think that's the key to success in our space, right? You can't.
I think it's always a balance to maintain what makes these things special, makes them tick, with having permanent or quasi permanent capital.
Right.
That's always the balance. And so it's at some point we'll get a decision in front of us to think about.
Fair enough. All right. I like that.
That'll be part 2 of our podcast.
Yeah, part 2. Definitely got to get you guys back. And I want to close out with one last question for you, Steve. And this goes to the kind of the next few years for Templeview Capital. And what are you guys concentrating on? What are you guys excited about moving into 22, into 23 for Templeview?
So growth, we do want to continue to grow. We've got we have the right balance sheet now. We've got to kind of fill out our production staff and systems. We've done a bunch of product enhancements. We've opened up new channels of origination. So we'll continue to push all of those to grow. We feel very good about that. We'll probably look at a couple new products, and I think that one, like I talked about, kind of like putting out innovative products. The Airbnb or short-term rental product we think is pretty innovative. Rolled it out, so that's great. And I think we're working on a construction to perm product. So one close construction to perm, and that could be really appealing to people who want to follow the BRRRR strategy, right? To buy, rehab, rent, refi, or whatever without having to refi, and just have it as a traditional kind of one close construction loan. So hopefully by the end of the year we're talking about that. And then it's just a question of like making sure that we're not seeing bubbles or areas of risk. So far we haven't. We do watch home affordability indexes pretty closely. We watch days on market. We watch we pull all sorts of data. We're kind of data junkies. We pull all this data. We've been doing this for years, for our NPL book, and so we do Templeview. And so far, like, it's a pretty even, there's areas that we prefer maybe not to lend at maximum kind of LTVs. But for the most part, most of the country's pretty healthy. Like, again, there's real tailwinds behind us. And so we feel pretty good about it. But
are there any MSAs that you're really excited about?
We're risk managers. So usually if you ask me, I tell you MSAs that I'm not excited about.
Okay. Let's hear it.
But I'll tell you what, how about Austin, Texas? Like, you can lend, like, Southern California is moving to Austin, Texas.
Yes.
So,
I get emails every day.
Not hurting Southern California property.
Austin. Yeah.
Yeah, Austin's crazy. So I think that'll probably cool down a little bit, just because they can't meet the demand. Like, there's so much demand, you can't actually build
enough room. They only have 2 million people.
Permits or room or anything, right? There's pockets of the Midwest that might be a little bit soft that we'll keep an eye on. But for the most part, the market, the world's pretty healthy. I mean, it's about finding good deals,
right,
and finding the right values and finding the right borrowers who have experience in those markets. So we're being very careful about that.
I like it.
So
well, data,
keep on trucking. That's
exactly. The data and entrepreneurialism combined, I like it. That's a really good mix. Well, you know what? I think that's all we have a time for today, Steve. I want to thank you once again for joining us on Lender Lounge. It's been fun getting to know you and your story. and the company story. We'll see you guys at the next show sometime soon, and hopefully we'll see you, Steve, out there at an event as well.
Great. Kevin, it's been a pleasure. I appreciate your time.
All right, thank you very much.
Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Jurassic. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.